Okay, let's dig in. Just picture this for a second. You're leading a big company. Maybe you're the CIO, CMO, could be the CFO, right?
Uh-huh.
You've got these huge strategic decisions to make. The economy's shaky, vendors are everywhere, data's flying at you, and then there's all this noise around AI.
Yeah, the hype is intense.
Exactly. So, what's it worth? What premium would you honestly pay for one single clear source? Something truly objective, actionable, something you can trust to cut through all that clutter.
That question, I think, really gets to the heart of the business we're diving into today. We're looking at Gartner, Inc., ticker IT.
The leader in tech research and advisory, no question.
The undisputed leader, yeah. And our mission here is to understand the why. Why is this company so financially resilient? What's the secret sauce behind its strategic moat?
Especially now, right? Through these, let's face it, pretty challenging economic times we've seen from, 2023 into 2025.
Precisely. How do they keep performing so well?
So we've got some great material to work with. Really comprehensive investment analysis, detailed competitive reports, and crucially, their latest Q2 2025 financials hot off the press.
A proper deep dive.
It really is. And I think to really get Gartner to understand why it's such a high-quality, high-margin operation, we need to start with its structure. It's built on these three pillars, and they work together in a really interesting way.
Yeah, that synergy is key. Okay, pillar number one. This is the big one, the anchor. And interestingly, they just renamed it, which tells you something strategically.
Yeah, it used to be just research, right?
It did. Now it's insights.
Uh-huh.
And this is the absolute bedrock. We're talking about roughly 82% of their total company revenue back in fiscal 24.
Okay, let's pause on that renaming because, Q2 2025, it officially became Business and Technology Insights. That's not just fluff, is it? It feels like a deliberate signal about broadening their reach.
I think it absolutely is. Management said they made the change to reflect the value they deliver across the entire business, not just the IT department anymore.
So they're aiming beyond the CIO's office.
Explicitly, they're saying, look, we have strategic insights for HR, for supply chain, marketing, finance. It's an enterprise-wide play now.
Right. And the model itself, it's basically a financial dream, isn't it?
It really is. It's all subscription-based. That means highly predictable recurring revenue. Clients pay for access to this huge library of research, proprietary data, tools.
But the secret weapon, according to the sources, is the people.
That's what jumps out. It's the on-demand access to Gartner's army of experts, over 2,500 analysts globally. That direct, personalized advice seems to be what really justifies the premium price tag.
And you see that value reflected straight away in the financials, the profitability of just this one segment. It's pretty staggering.
It is. So, Q2 2025 numbers. Insights brought in $1.319 billion. That's up 4.2% year over year. Solid growth.
But the margin, that's the headline number here.
Exactly. The gross contribution margin, 73.9%. Exceptionally high.
73.9%. Let's just let that sink in.
Yeah, I mean, that's the kind of margin you see in pure intellectual property businesses. Think software, maybe pharma.
Right, because their cost of goods sold is minimal. They're selling knowledge, access.
Exactly. It's highly scalable. For every dollar of subscription revenue, almost 74 cents flows through to cover operating costs and ultimately profit.
And that consistent high-margin cash flow is what fuels everything else, right? It lets them invest, pay those top analysts.
It provides that crucial stability. Which brings us nicely to the second pillar, conferences.
Okay, so this is smaller, about 9% of revenue in 2024.
Yep, around 9%. And it's a different beast altogether. It's a platform, really, for learning, networking, but also a really important sales channel, especially with vendor sponsorships.
And much more volatile, as the sources point out.
Oh, absolutely. Just look at the pandemic impact. It plummeted when events stopped.
Right.
But then a massive rebound, like 90% growth in 2022 as things opened up, then another 15% in 2024.
So it swings with the cycle, but people clearly still value that in-person connection.
The demand is definitely there. And the latest numbers show it's strong again. Q2 2025, conferences revenue was up 13.6% year over year, hit $211 million.
Still very profitable, too, even if not insights level. Contribution margin of 57.4%.
Still very healthy, yeah. But you just have to accept that lumpiness, the event-driven nature.
Which leads us to the third piece of the puzzle, consulting, also around 9% of revenue.
Correct. So if Insights is the scalable subscription engine and conferences is the high-profile networking hub,
then consulting is more hands-on, project-based.
exactly. It's where they take the core research and apply it to specific client projects. custom analysis, implementation support.
Moving from the what to the how, helping clients actually execute.
Precisely. But, and this is key, it's much more transactional.
Meaning it's more sensitive to budget cuts. If times get tough, project spend gets paused.
That's typically how it works, yes. Big consulting projects are often easier to defer than that core insight subscription, which clients see as essential.
And the margins reflect that difference too.
They do. Consulting revenue in Q2 was $156 million, up a respectable 8.8%. But the contribution margin was 39.6%.
Significantly lower than the other two.
Right, because it takes more direct human effort per dollar of revenue. Less scalable than selling a report that thousands can read.
But they all work together, don't they? That's the synergy you mentioned.
Absolutely. The insights feed the consulting ideas, the conferences build the brand, and generate leads for both. The reinforcing cycle deepens the client relationship at multiple touch points.
Okay, so that amazing 74% margin in insights,
Yeah.
it only holds up if the business is really, really defensible. Let's talk about Gartner's moat.
Yeah, and it's arguably one of the strongest moats out there in the corporate world.
Mm.
It really rests on a few key things working together. Their independence, the power of the brand, all that proprietary data they gather, and strong network effects.
The famous flywheel.
Exactly, the self-reinforcing flywheel. That's the core story. And it starts with trust, with that independence. Gartner doesn't sell the tech, they sell the advice about the tech.
Which attracts the big clients. How many are we talking about?
Around 14,000 distinct enterprises globally. Big names.
Okay, so walk us through how the wheel spins. Those 14,000 clients, they're constantly interacting, right? Calling analysts.
Constantly. The data point was over 500,000 direct client interactions in 2024 alone. 505,000 calls.
Wow. Executives asking really specific, high-stakes questions.
Exactly. Which vendor should I choose? Is this cloud strategy right? What about this AI tool? Real-world problems.
But it's not just clients asking questions. The vendors are feeding information in too.
They pretty much have to. Gartner's influence, especially things like their Magic Quadrant reports, is just too significant. Vendors need to be represented, need to brief the analysts.
How many briefings are we talking?
Over 27,000 vendor briefings a year. Think about that. 27,000 private conversations where companies share roadmaps, challenges, strategies.
And all of that intel, the client questions, the vendor briefings, the analysts' insights, it all gets captured.
And it's proprietary, completely exclusive to Gartner. They've actually quantified it as generating several terabytes of highly proprietary data.
Terabytes. This isn't stuff you can find on Google.
Not even close. It's the aggregated intelligence of the entire global IT ecosystem, filtered and analyzed by Gartner. And that data fuels the next generation of research.
Making it better, more relevant, more actionable.
Than anything competitors can produce, because they don't have that raw data feed.
And better research attracts more clients.
To generate more interactions, more data.
Spinning the flywheel faster and faster, widening the moat.
It's a powerful combination of network effects and a unique data asset. If you're a competitor, how do you possibly replicate that? The trust, the analyst base, decades of data. It's a huge barrier.
And you really see that barrier when you look at the competition. Who are the main players they go up against?
Well, there's Forrester Research, which is also public, but much smaller. There's IDC, which is private. And then you have the big management consulting firms, McKinsey, Accenture, who play in the higher-end strategy space.
But the scale difference, particularly with Forrester, it's not even close, is it?
It's genuinely shocking. Gartner's doing over $6 billion in revenue. Forrester. Fiscal 24 revenue was $432.5 million.
So Gartner is, what, more than 10 times bigger?
More than 10 times the size of its nearest public competitor. It's not just a gap, it's a chasm.
And that scale allows for massive reinvestment. More analysts, better tech.
Orders of magnitude more investment, which, again, reinforces the quality perception. If you're betting millions on an IT project, you go with the deepest bench, the best data.
And this really showed up during the recent economic turbulence, 2023, 2025. It was like a stress test.
It really was.
Yeah.
And it highlighted this phenomenon often called the flight to quality.
Meaning when budgets get tight, companies double down on the essentials.
Exactly. Look at the numbers. In fiscal 24, when spending was cautious everywhere, Gartner still grew revenue by 6%. Forrester, in that same period, actually shrank by 10%.
Down 10% versus up 6%. That's a stark divergence.
It tells you everything. It suggests that enterprises view Gartner not as a nice-to-have, but as must-have insurance. They cut the smaller, perhaps more discretionary providers first.
So downturns actually strengthen Gartner's position relative to competitors.
It appears so. They consolidate spend with the indispensable player. The moat actually gets deeper when the tide goes out.
Okay, so the moat is strong, but what about future growth? Even with recent slowdowns, the long-term picture seems pretty bright based on the sources.
Yeah, the long-term drivers are powerful and largely secular. It really boils down to the ever-increasing complexity of technology and the constant need for expert guidance.
The sheer amount of money flowing into IT helps, I imagine.
Massively. Worldwide IT spending.
Mhm.
The projection for 2025 is $5.61 trillion.
Wow.
And the piece Gartner plays in, IT services, that's growing steadily too. Expected CAGR of 7.9% through 2030. So they're riding a huge ongoing wave of digital investment.
But the problem for leaders is keeping up, right? Cybersecurity, cloud, digital transformation, it's just relentless change.
It creates what we called earlier information chaos. There's so much noise, so much risk in making the wrong multi-million-dollar bet. That's where objective, data-backed advice becomes critical.
And the latest catalyst supercharging all of this, AI.
Absolutely. The sources are crystal clear. AI is the #1 topic, the highest demand area across Gartner's entire client base right now.
Not just curiosity, but real strategic need.
Urgent need. How do we use it? What are the risks? Which vendors are real? And with global AI spending forecast to grow at, what, something like 29% CAGR over the next few years,
29% compound growth.
that fuels demand across all three Gartner segments.
Yeah.
More research needed,
Yeah.
insights, more conference sessions and sponsorships, conferences, more strategic help implementing it, consulting. It's a massive tailwind.
But besides the market growing, where does Gartner's own growth come from? Is it just finding new customers?
Actually, finding brand new enterprise clients isn't the main focus, surprisingly. They serve about 14,000 enterprises now.
Which sounds like a lot, but compared to the size of the market.
It's a small fraction.
Yeah.
So, yes, there's room to add new logos, but the biggest growth lever, their core strategy, is land and expand.
Meaning selling more within the clients they already have.
Exactly. Increasing penetration, selling more subscriptions, more seats to different teams and individuals inside those 14,000 companies, getting deeper into the organizational chart.
And this is where that CEB acquisition back in 2017 was so important. It was about moving beyond the traditional IT buyer.
Precisely. CEB gave them the platform and expertise to aggressively expand beyond the CIO and their team what Gartner calls global technology sales, or GPS,
Into all the other departments.
which they now call global business sales, or GBS. Think HR, sales, marketing, finance, supply chain leaders.
So is that expansion strategy actually working? Can we see it in the numbers?
We absolutely can. And this is probably one of the most important data points right now. In Q2 2025 GBS contract value.
Right.
Remember, CV is future subscription revenue.
Right, the key forward-looking metric.
GBS CV grew 9.2% year over year.
9.2%.
Okay.
Okay, how did the traditional IT side GTS do?
GTS contract value grew 3.6%.
Okay, wow. 9.2% versus 3.6%. That's a huge difference.
It's massive. It tells you that even while the core, mature IT market, GTS, is facing cyclical slowing, the expansion into other business functions, GBS, is significantly outperforming and offsetting that weakness.
So the strategy is working. The growth engine is shifting.
It's shifting from just selling more to the CIO each year to selling relevant insights across the entire C-suite, leveraging that same core data asset. GBS is clearly positioned as the driver for future growth acceleration. They're winning more wallet share across the whole enterprise.
Okay, but we can't ignore the recent slowdown. We have to address the headwinds. That key metric, contract value, slowed to 4.9% growth in Q2. That's well below their usual double-digit target.
Right. And it spooked the market a bit. But what's interesting is how upfront management has been about why it slowed. They're attributing it quite specifically to temporary cyclical factors, not a fundamental breakdown.
And they've actually put numbers on these drags.
They have, which is helpful. It gives you a sense of the potential bounce back. The first big one is the U.S. federal government.
Ah, yes, the DOGE factor they mentioned. Department of Government Efficiency. Sounds bureaucratic.
It is. It relates to new procurement processes, budget scrutiny, essentially more red tape.
So the government didn't necessarily stop buying, it just got slower at processing the renewals.
That's the key point management made. The new rules created friction, delayed contract signing, so they didn't hit the CV numbers as quickly. They estimate this single issue was a 200 basis point drag on overall CV growth in 2025.
2 full percentage points just from government procurement changes.
Yes. And crucially, they expect this to normalize in 2026 as everyone adapts to the new system. So those 200 basis points should theoretically come back.
Okay, what was the second drag they quantified?
This one was from specific industries impacted by tariffs. Companies in those sectors were under heavy margin pressure and implemented aggressive cost-saving measures.
So maybe delaying decisions, escalating approvals higher up.
Exactly. Again, not necessarily canceling, but slowing down the deal cycle. Management put this drag at least 100 basis points.
Okay, so add those up. 200 from government, at least 100 from tariff-hit sectors. That's 300 plus basis points of CV growth headwinds right there that they see as temporary.
That's the argument. If those normalize as expected, it provides a clear path back towards higher single-digit growth just from lapping these issues.
Makes sense. Now, strategically, how are they defending against the elephant in the room, generative AI? Isn't there a risk people just use ChatGPT instead of paying for Gartner?
It's the obvious existential question for any knowledge business, right? And Gartner's response is proactive. They've developed Ask Gartner.
Their own AI tool.
Exactly. But here's the clever part. It's built on top of their existing moat. It uses their unique data.
Ah, so it's not just scraping the public internet.
No, the key phrase they use is it's fully grounded in our proprietary, independent, and objective insights. It leverages those terabytes of exclusive data we talked about.
So it combines the speed of AI with the reliability of Gartner's vetted research.
That's the goal. Give clients faster answers, but answers they can trust because they come from Gartner's knowledge base, not the Wild West of the internet.
And does it seem to be working? Are clients liking it?
Early pilots sound promising. They reported efficiency gains, finding answers up to 75% faster. That increases the value, the stickiness of the core subscription.
And crucially, are they seeing clients cancel because of public AI tools?
Management's comment was pretty direct. They said churn due to generative AI is currently not material. It's essentially unmeasurable.
Unmeasurable. Okay, that's a strong statement. Suggests Ask Gartner is doing its job as a defensive play, at least for now.
It seems to be neutralizing the immediate threat by highlighting their unique data advantage.
And this kind of disciplined response seems reflected in their overall financial management, too, even though they lowered revenue guidance for 2025 because of those headwinds.
Which was realistic, given the CV slowdown.
Right. But they maintained their adjusted EBITDA margin outlook and actually raised their adjusted EPS guidance.
That's impressive financial control. It shows they can pull levers, manage costs, and protect profitability even if the top line slows down a bit. Speaks volumes about the operational leverage in the model.
And the cash flow. The sources describe it as prodigious.
It really is. Because clients pay up front for subscriptions, they generate massive free cash flow, over $1.3 billion in 2024.
And it's a capital-light business, right? They don't need huge factories or inventory.
Very capital light,
Yeah.
which leads to exceptional returns on capital. Their ROCE, return on capital employed, is around 25%.
25%. How does that compare?
The average for the IT industry is under 10%, maybe 9.8%. So 25% is stellar. It shows for every dollar invested in the business, they're generating significant profit. Highly efficient model.
So they're generating all this cash, over $1 billion a year in free cash flow. What are they doing with it?
Their capital allocation strategy is incredibly focused. It's almost entirely about one thing: share repurchases. Aggressively buying back their own stock.
No dividend, then.
Nope, no dividend. They're signaling pretty clearly that they believe the best use of cash, the best return for shareholders, is reducing the share count, which implies they think the stock is undervalued long-term.
And they've put serious money behind that belief.
Huge amounts. Over $4 billion repurchased just in the 4 years leading up to early 2025.
$4 billion. And that directly boosts earnings per share, right? Even if overall profit growth slows.
Absolutely. It's simple math. Fewer shares outstanding means each remaining share represents a larger piece of the profit pie. We saw that in Q2, adjusted EPS grew 9.6%.
Which was faster than their underlying profit adjusted EBITDA grew.
Exactly. The buybacks provided a significant chunk of that EPS growth. It's a powerful lever, especially when organic growth is temporarily slower.
Okay, so strong business, lots of cash flow, smart capital allocation. But the stock's valuation multiple has come down quite a bit.
It really has. Historically, Gartner traded at a hefty premium. Price-to-earnings ratios in the mid-30s, sometimes even up into the 50s, a real growth multiple.
And now because of the CV slowdown concerns.
Now, the skepticism has kicked in.
Yeah.
The TTM-PE ratio is compressed down into the, say, 15x to 18x range, and EV to EBITDA is maybe 13x to 15x.
Those sound much lower.
They're near 5-year lows for
Yeah.
Gartner. The market is basically pricing it like it's already in a cyclical trough, like it's a mature, moderate growth company, not the premium leader it used to be valued as.
So expectations seem pretty low right now.
Fully reset, I'd say, which paradoxically might create the opportunity if you believe the slowdown is temporary.
Which brings us perfectly to the bull versus bear debate. Let's lay out the bull case. What's the argument for the stock from here?
The bull case is all about that reacceleration. The core arguments are, 1, the moat is intact, maybe even deepening with Ask Gartner and the flight to quality. 2, those headwinds we dissected, the DOG effect. The tariff impacts, they're cyclical, they're temporary, and management has quantified them. They expect a return to high single-digit CV growth in 26, maybe double digits in 27 as these things normalize.
And normalizing those headwinds alone adds back, what, 300, 400 basis points of growth?
Easily. Plus, underlying demand, especially around AI, remains strong. And third, the aggressive share buybacks will continue to juice EPS growth, potentially leading to a re-rating of that compressed valuation multiple back towards historical levels.
So growth comes back, buybacks continue, multiple expands. That's the bull thesis.
Pretty much. Now, the bear case, what are the risks?
The big fear is always a deep, prolonged recession, isn't it? Could that finally force companies to cut even Gartner?
That's the primary cyclical risk. If CFOs face extreme pressure for long enough, does even the mission-critical subscription eventually get scrutinized or downsized?
And the structural risk, still AI.
It has to be. The bear argument is that maybe Ask Gartner is just a stopgap. Maybe public generative AI just keeps getting better, cheaper, faster, until it becomes good enough for many tasks.
Eroding Gartner's pricing power over the long haul, making it less essential.
Exactly.
Yeah.
If AI democratizes access to pretty good insights, does Gartner lose that indispensable insurance policy status and become more of a luxury item? That's the long-term technological threat.
So the current low valuation kind of reflects those fears. The market is pricing in a scenario where growth stays lower for longer, maybe because of recession or the AI threat proving more real.
I think that's a fair assessment. The low multiple suggests the market needs to be convinced that the reacceleration story for 2026 and beyond is real before it's willing to pay a premium again. #outro. So let's try and wrap this up for you. What we've unpacked here is a business fundamentally built on a very high margin, very sticky subscription service, that Insights segment.
Protected by a really powerful moat based on unique data, brand reputation, and scale. A scale so large, actually, that it benefits from uncertainty as clients consolidate spending.
Yeah, that flight to quality is key. And looking ahead, the growth path relies on huge secular trends. Think IT complexity, digital transformation, and especially AI, coupled with a clear strategy to sell deeper into existing clients via that GBS expansion.
GBS being the key growth engine now.
Definitely the one to watch, which leads to the single most important metric for you to monitor going forward: contract value, CV growth.
Every quarter.
Every quarter. Watch the overall CV growth rate, but pay close attention to the difference between GBS growth and GTS growth. That GBS outperformance is the clearest sign of whether that crucial expansion strategy and the overall reacceleration thesis is playing out.
Okay, so CV growth, especially GBS versus GTS. Got it. Now for a final thought, something for you, the listener, to chew on after this deep dive. We've talked a lot about Gartner's model resting on objectivity, trust, and proprietary expertise in this age of, information chaos. But general purpose AI, the public stuff, it's getting incredibly capable, incredibly fast, and accessing more and more real-time data. So here's the question. Over the next, say, 5 to 10 years, what specific, truly irreplaceable human element do those 2,500 Gartner experts provide? What function, what quality will ensure Gartner can still command that premium price and maintain its non-negotiable status when AI can answer so many factual questions instantly? What part of judgment or accountability or maybe strategic foresight can AI not replicate?